Let's now connect with Harendra Kumar, Managing Director of Institutional Equities with Elara Capital. Harendra, let's first start with the news point. And the news point is NTPC OFS, one day, less than 12 hours, and that issue was able to mobilize 12,000 crore. 12,000 crore means more than $2 billion.
Yeah, absolutely. I think it's fantastic. I think it's well managed, well marketed, and 2 or 3 points that work. The free float for such a large company increases. Second, its weight on the MSCI index automatically goes up. So clearly, the fund managers will look perceiving this issue as something very, very important, and it's sailed through. But obviously, the progressive direction of the stock over the long term is still circumspect given the overhang on the power sector. But overall, as an event, it's a positive in terms of the fiscal deficit, the way it was managed, and overall for the Nifty constituents.
Harind, what have you made of the declining trend that we've seen from the cement majors? First, it was the mid-cap lot, and yesterday we saw poor performance from ACC as well as Ambuja too.
Yeah, I think the key was the volume numbers. The market had overestimated the volume numbers for some of the cement majors. I think there is some amount of acceptance coming. The volume numbers would not be met and be closer to around 10-11%. That's where the valuations are correcting. Our call is that the cement sector will behave very differently from what it behaved in 2012. So there could be pockets of strength, especially in north-based players, and some of the larger ones are likely to underperform. So it's going to be more stock selective approach towards cement rather than a secular run-up that what we witnessed in 2012.
Harendra, so should markets now breathe a sigh of relief that the jumbo NTPC issue is out of the way and now supply-demand dynamics will change again?
Actually not, Nikunj. If you look at it, we've been reading newspapers that from here up to June there are 2 or 3 floats every 2-3 days. That would mean that the entire liquidity will go towards new issuances. And here I would like to point out that the current state of the market is similar to what we saw in 2004. Where we followed a very great year of 2003, but the index gave very little return despite extremely high flows, and that could possibly get repeated this year as well.
Harendra, if I map market internals, at least in last 2 weeks, large cap stocks are holding on. The real pain is there in the mid cap stocks. Just about everything from the real estate space or the high beta space is suddenly back on the butcher block.
Actually, Nikunj, the high beta trade is a trade that has failed perpetually over the last 1.5-2 years. I'm surprised that the street continues to discuss this trade because we are not going to see a sharp rate cycle in terms of this calendar year at least. Plus, the whole macro environment is very, very benign. So the delta in earnings for some of these players are not likely to come. We are very underweight on power, infrastructure, or real estate for that matter. You will see this reversion to mean trade for these stocks happening time and again, but they are clearly not to be long-term held. You saw that when Chidambaram came to power, you had the spike in some of these stocks, and a follow-on when you saw this now the risk-on trade. But clearly, this trade remains for a month or two, and then it reverses to the mean. So I don't think it's going to sustain through the year as well.
Harind, how are you going to approach some of the consumption names? We saw what Jubilant Foodworks does. Titan as well lost a fair bit yesterday. And Tata Global Beverages too hasn't had the best of days.
Yeah, see the consumption pack, you saw a huge polarization last year where you saw that some of the stocks had significant PE rating, and now that seems to be coming off. But there are pockets of valuation in consumption for that matter. Dabur, which is just looking to play catch up. You have Marico, you have Berger Paints. The paint story is shaping up very beautifully in terms of volume and value growth. So there are pockets of value. Consumption is strong, but there's a valuation mismatch. I think the year to trade with is the valuation arbitrage between some of the large cap and some of the second, third incumbents within the same space, and that should be more profitable as a trade than sticking to the larger names.
Harendra, at the current juncture, to your mind, where exactly are markets mispricing growth? First on the upside and then on the downside.
So, if I heard you correctly, where are the surprises?
Or where are opportunities?
Yeah, I think, Nikunj, what the street is still under-owned is technology as a space. I think that's where the interesting development that one should watch out. We've been speaking about the global recovery. In fact, you have started the program on that. And if you look at the way the Dow is behaving, the IBMs of the world are behaving, and yesterday's flat Cognizant results, these are huge positive for Indian tech companies. And the valuations are also very attractive. So if you're looking for outperformance, that could possibly come from technology sector.
Do you see a scope of P expansion in a stock like Infosys?
Yes, I think it will also come from earnings growth, where the utilization rates are pretty benign now for Infosys. I think progressively they look to correct that over the next 3 to 4 quarters. So there will be rupee tailwinds as well as margin expansion. So my guess is that the street will be slightly behind the curve in terms of the earnings of the rates.
So Harind, I mean, is your view that perhaps markets in the near term are going to shift back to defensive stocks and thereby outperformance from pharma perhaps?
Yeah, see, it's not about defensives, it's about where the strengths are. If you look at the whole space, the way that 2012 behaved, you had, huge micro rallies in consumption, pharmaceuticals, cement, media, and I think the trend continues. Nothing has changed in 2013, which was not there in 2012. So you have intermittent spurts in terms of the so-called beta trade, but they never sustain themselves. So you have these progressive trends continuing in some of the sectors that I mentioned, but there could be sector rotation going into this year. So that's primarily what we are saying, is that some of the large and cap names where the valuations had touched very peak could underperform, but you could have some other stocks within the same space, say like you mentioned Aurobindo and Pharma could surprise you this year, where valuation is cheaper compared to some of the large cap names.
Yesterday everybody was talking about Strides. But surprise, surprise, today nobody's talking about Strides. Whereas Strides, yesterday it collapsed. It corrected. And it corrected on very, very strong volumes. 916 rupees for Stride. It corrected more than 12.5% on an intraday basis. The intraday low was about 868, 860. Harindra, Strides, what happened yesterday? Who sold? Who got out?
We don't track Strides, so it would not be fair to comment on something that we don't cover.
Have you heard anything? Come on, I know you got your ears close to ground.
Not that I've heard.
And I guess it's important for me to point out that the IT space, which had got polarized, now will get polarized more and more further, because there are some companies which are growing, there are some companies which are recovering, and there are some companies where the revenue or where the earning trajectory seems to be declining. So TCS is growing, Cognizant is growing. If you look at Infosys is recovering, but Wipro, the earning trajectory pretty much is coming on the downside now. Hendra, would you agree with my assessment that the IT space had got polarized, and now after Cognizant numbers it will get even more polarized?
Yeah, but the point to be noted here is that the US is recovering extremely strongly. Some amount of inefficiencies or complexities in the business model will get addressed as the macro recovers in the US, and that will likely aid some of the larger players as well. So today's environment is very tough, and that's why the polarization is very, very stark. But as the macro sustains, you will see some amount of improvement in performance there as well. Clearly, but the larger guys will do much better compared to some of the names that you mentioned. But the performances from here progressively Q on Q, I think you will see good amount of improvement going into the next financial year as well.